Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're very fortunate to have with us Rich Pzena. Rich is the founder of Pzena Investment Management, established in 1995. He is principal, chairman, co-chief investment officer, as well as a portfolio manager at the firm. Prior to founding the firm, Rich was the director of U.S. equity investments and chief research officer for Sanford C. Bernstein. Currently, Pzena manages approximately $80 billion, focused on a disciplined, valued investing approach across 27 strategies. Rich, welcome to the Compound Insights podcast.
Thank you. Happy to be here.
Obviously, tremendous accomplishment to build a firm up like that to $80 billion from ground up. Can you share with us how the firm evolved over time? What were some of the keys to success for those who are sort of aspiring to be emerging managers today?
Well, 30 years ago, and it's 30 years now, so we just celebrated a big anniversary. At the outset, all you do is hope that you don't go out of business. And mostly it was a dream. I had been at Sanford Bernstein. I watched them grow from a relatively small firm. When I joined there, they had about $4 billion in assets under management. And when I left, coincidentally, they had about 80, actually. And I watched what they did from 4 to 80. And I thought there were some great aspects of what I could take away, which is maintaining a disciplined valuation approach, focusing on research. But there were also things that I didn't want to do, which was have no limits on the assets you take in any individual strategy. And because it makes it more and more difficult to execute a strategy. If you have a concentrated value strategy, and even 40 years ago when I joined Bernstein, if you have a 30-stock large cap value strategy, and all of a sudden you find yourself managing $30 billion, which is what happened, you would have to find 30 cheap stocks that could absorb $1 billion, which at the time, 30 to 40 years ago, wasn't easy. So they went to 40 stocks, and then 50 stocks, and then 60 stocks. And so we didn't want to do that. We wanted to be pure, not be impacted by those issues, yet be disciplined as a value investor. So that was the premise of when I started. The reason, mostly, it's a dream. I mean, you're doing something that you love and you think you're pretty good at it, and you have to have a little bit of craziness to go out and quit your job and try something new. Not new, but try something on your own in a world where the success rates are not that high. But to me, what created the firm, you have to get a little lucky, and we were lucky. The first 2 years were pretty good. And then we went into 2.5 years where the only thing that mattered was the internet. And we had this amazing internet bubble where stocks went up and up and up and up, and we did nothing and nothing and nothing and nothing. And after 5 years, found ourselves 6,000 basis points behind the S&P 500, 60 percentage points. So you sort of say, it's over. Who's going to ever hire you? And some of the early luck we had in attractive clients turned around, and we started to have some redemptions. But we stayed disciplined. We met with all of our clients that we were fortunate enough to have attracted, and said, look, I don't understand what's going on. I'll just give you a funny story, because probably the most memorable client experience that I had. A woman came into the office, sat down, and said to me, my grandmother is a better investor than you are. All you have to do is buy Cisco. Everybody in the world has figured this out except you, and you're just stubborn. And so I tried to do arithmetic with her. I said, at the time, Cisco was the first company to hit $500 billion valuation. Now that's like peanuts almost. But, I said, if you were going to buy the whole company and write a check for $500 billion and you want to make 20% a year return, they have to earn $100 billion a year, and they earn $1 billion a year. Don't you think there's something wrong with that? And she said, you don't get it, do you? To which I agreed. And so we stayed disciplined. We had a whole host of things that were really interesting to buy at the time. Many, many, many of our competitors gave up during that period of time, changed their stripes, added stocks just so that they wouldn't be missing out. Even if you didn't put Cisco in, there were people who put value investors that put IBM in their portfolios that were also elevated in valuation, and we didn't. So when it turned in 2000, we had a unique position and had kind of 5 straight years of really spectacular investment performance, and it's what made the firm.
And do you think, it's an interesting point that back then even people did not appreciate value investing. Do you think today there's still some aspect of it that's sort of misperceived or sort of underappreciated by investors?
Well, I mean, it's been such a laggard for so many years that it's not irrational that people have some doubts about value investing. What I like to point out is that performance of traditional value, I'll talk not just about us, but people that engage in traditional value investing, the last 10 to 15 years have been no different than the prior 10 to 15. So we've chugged along making 10, 11, 12% a year. But then the market went to 14 and 15% a year. And after a long period of that, you sort of say, why would anybody want to do value investing? And my response is, if you can make 10 to 12% performance over a lifetime, you're going to wind up being very, very happy with that, and you shouldn't be overly influenced by what's going on in the marketplace. And the marketplace today, we all know the issues. Big tech companies that have giant franchises that have done wonderfully, no doubt about it. But an ownership in the S&P 500 is a highly concentrated bet on those companies. And for us, as a business philosophy, saying this is what we do, not what they do, has been the reason for our business success. And so to me, nothing has changed in value investing. What's changed is the environment, the alternatives that people have had to value investing, and they are extrapolating the last 10 to 15 years into the future, no matter how unlikely that actually is to occur.
And over that time, has your investment process sort of evolved? Has it changed how you find
Sure.
companies and things like that?
I mean, the actual process is unchanged. The actual process is pretty straightforward. We're trying to find businesses that are selling at a low price relative to what their sustainable long-term earnings power is over a full economic cycle. That sounds like motherhood and apple pie, but the reality is, when you're doing this for a long time, you also wind up at times being on the other side of the table, listening to presentations that other investment managers make. And it always struck me that no matter what you do, whether you're a value or a growth stock investor, people say the same thing. We buy good businesses for low prices. That's what we do. And I have a much more realistic view because good businesses don't sell for low prices. What sells for low prices are things where there's something going wrong. Doesn't mean they're bad businesses, but it means they may not be performing today. And if you have a healthy dose of realism, the realism being that you don't get to buy what everybody wants at a low price, and what everybody wants is fast growth, high margins, dominant market position, strong management team, clean balance sheet. I mean, everybody in the world would describe a good business exactly the same way. And thinking that you can get one of those at a low price is kind of irrational.
And as part of the process, quantitative, qualitative factors you take into consideration, touched on the balance sheet, low price. Are there particular metrics that sort of use in your screens that you're willing to share and things
Sure.
like that help you construct your investment mosaic?
Well, we use a concept called normal earnings power rather than current earnings. So if you think about what normal means on a naive basis, and you can't go and look up what's the normal earnings power of a company. You can look up its book value, you can look up its current earnings. Normal earnings is, from our perspective, on on stage one is a simple concept. If you know what business the company is in and how has it done over the last 10 years, what would you naively extrapolate from history? So, for example, if the company grew 10% a year and had 14% operating margins on average for the last 10 years, assume that happens into the future and extrapolate that. So you're going to get the average margin, the average growth rate, and you can go out a few years and then rank the universe based on price compared to that number. What you're going to find is what's at the top of the list, which are companies that are selling for a low price relative to what their histories suggest they earn in the future, is a very, very rich universe to go in and look for true value. Because what happens is the computer is just drawing a line that extrapolates the past. The reality is often that the present is not on that line. Something has happened in the business that's caused the earnings to deviate from that historic norms, and the market reacts negatively, sometimes significantly negatively, but the problems may not be permanent. So very often there are gems in those, and that's what we use for screening. That's what we use for valuation. You asked about the evolution of the process. The basic fundamentals of that have never changed. What's changed is refining what we mean by a good business and what we mean by stress. Because I think one of the misconceptions of value investing is that you're buying lousy businesses with crappy balance sheets that are distressed. But value is not distressed. Distressed is a very, very different topic. Distressed is when there's excessive financial leverage and the company may or may not make it. And debt, high leverage, is not a friend to value investors because the creditors, you don't know how they're going to behave. And if they decide to pull the plug in the short term, then you're out of luck as a value investor. If you're playing distressed, there are much better ways to do that in the capital structure than being the equity investor. So we're sensitive. The evolution is making sure that we don't have excess financial leverage in the portfolio, making sure that we don't buy quote unquote bad businesses, meaning that over their full life cycle, they don't ever earn a reasonable return on invested capital. So you can have cyclical businesses that at times don't earn good returns, but on average are good businesses. We would love to be in those. Ones where, that it's just luck if you play the cycle right, rather than buying some business that has some advantage, is not what we want to do. So those things have emerged into our process over time.
And what about items that don't necessarily show up on a financial screen? Things like corporate governance, capital allocation. How do those factor into?
Well, they factor in the qualitative part of the analysis, because if you think about what the screen that I mentioned will bring to the forefront are business that are under earning their historic norms. So then you have to go in and actually do some thinking. The easy part is the screening part, and you can make a life just doing the screening and not doing the qualitative part. But the qualitative part is basically answering three questions. Is this business any good? Are the problems facing it temporary and not permanent? And is the management's plan to restore the earnings back to their historical luster a sound and sensible business plan? That's the hard part, because there's no formula for how to do that, right? That is research. It's identifying reasons why you think the business ought to earn a good return. And you do that by looking at its history, but you also do that through basic research of interacting with their competitors, their customers, and seeing if the plan makes sense and makes common sense. So I would tell you that governance, or if you want to use the more ESG kind of term, for us, there's no difference between looking at fundamental business issues as there are looking at environmental or governance issues that could affect the company. If there's something wrong there, then it would be like finding something wrong in the business and you pass. It's just that what ESG evolved into was making judgments about whether this was a good business for society, as opposed to whether the issues of governance and the environment and social issues could have an impact on their business. And so we always ignored the things that were not significant financially and only focused on the things that were financially significant.
And given the comprehensive investment approach we just discussed today, are there particular sectors or geographies that you're finding a lot of value opportunities, and where do you see the most mispricing today?
Well, there's a couple of areas. Small cap is an interesting area of where there's mispricing, and the smaller the cap, the bigger the mispricing. So the things that people now view as uninvestable, which you would call micro cap, are just priced at, people talk about how the market is high. This market is way lower than its historical norms. So you can buy things at 5 times earnings or less, but they're small, illiquid, maybe not exciting, not growth stocks, but very cheap. So small is one area. Another area and we've had a big rotation in our portfolios into healthcare related companies, but healthcare, particularly healthcare services, and that means to a large extent insurers, are now very hated, and they're hated by both political parties because they deny coverage, they try to manage the care process, which basically means restricting access, and they've earned the ire of people. So we read it all the time, like a PBM, I'll use that example, which is an esoteric business, a pharmacy benefit manager. Their goal in life is to manage the pharmacy benefit on behalf of corporate plan sponsors who want to provide pharmacy coverage for their employees, but really can't do it on their own because they don't know how to set up the formularies, how to negotiate the prices. So they outsource that. And, when I first looked at a PBM 40 years ago, because they've been around for a long, long time, I kind of had the same reaction. This is kind of a business that will go away because they're a middleman. And the reality is that's not what they are. Now that I own a business with employees, I understand how important it is to engage a PBM. You actually have no choice. And the margin structure has been very flat over 40 years, and the business has grown and grown and grown and grown and grown. And you can buy them for single-digit multiples of earnings because they're cheap. So healthcare is one area. Small cap's another area. I would broadly say the companies that people have doubts about because of AI is another area. Things like information technology services businesses that were the ones that the big companies outsourced to upgrade systems, to engage, to transform their businesses to take advantage of new technology, like moving to the cloud. The whole effort of moving to the cloud was a bonanza for these companies. And now everybody's saying, well, we don't need anybody because ChatGPT is just going to do it, or the AI is going to do it. And so their valuations have come way in. And we suspect that companies, when they move full force into adopting AI, are going to seek advice on doing this, just like they've sought advice on every other technological change in business. So there's cheap stocks there too. I can keep going, but those are some examples.
Okay, great. What about value traps that can come up sometimes, I think, in value investing? How do you navigate that challenge from a portfolio construction perspective, that something appears inexpensive and then in the end, maybe it was inexpensive for a reason and it's sort of not going to come back?
Yeah, I never give a satisfying answer to that question, but I'll make my provocative answer. I don't think you can be a value investor if you try to avoid value traps, because you have no idea which are the value traps. You just don't. And so the whole effort of trying almost precludes you from being a true value investor. You have to say to yourself, I'm going to buy at a low enough price so that the ones that turn out to be value traps don't detract from my performance, because the ones that worked were so good. And that's why most people they add overlays like a catalyst, value with a catalyst, or you hear that all the time. The problem is if you wait for a catalyst to appear, you really missed the opportunity to buy at a very cheap valuation. Because once the catalyst is obvious, it's too late. And the idea that you're going to know the catalyst, but no one else is going to know the catalyst, is unreasonable. So I think you have to accept, and I think the only way to be successful as a value investor is to accept that you're going to get some things wrong. Now, I would say there are things that you can be careful of, like excess financial leverage is one example, or long-term lousy return on capital employed, or I'll just add one more, a declining business. Declining businesses are very tough for value investors because most public company executives can't handle the idea of a declining business. Private investors know how to do this beautifully. They just milk the business. They're not worried about the share price. They don't worry about what anybody thinks. They're worried about maximizing the cash flow stream over the remaining life of the business. Public company management teams say, I'm going to try something else. And usually that's a bad idea. So we would avoid businesses that are in decline. And maybe that's a better answer. I mean, to the value trap question. But I really think that you don't know which are the ones that are going to work and which are the ones that are. That's why they're so cheap, because it's not possible to know. And if you try and convince yourself otherwise, you're gonna be playing a different game.
What about when you're actually have the position on and maybe the thesis isn't playing out exactly as you would have hoped? What's the process you go through, the thought process in maintaining conviction versus the decision to sell and move on?
There's a lot of ways that people do this, none of which make sense to me. Most of which don't make sense to me. Like some people put stop loss orders in. They say, if I lose 25%, I'm out. To me, that means you had no idea what you're getting yourself into, and then it didn't work. So you were proved that you didn't know what you're doing, so you get out. But then there are other value investors who do the opposite. They just think they're always right, and they double down every time it goes down like that. Both of those make no sense to me. The fact that you lost money has no impact on what you should do today. You should re-underwrite the investment. Start over again. Sometimes that means giving it to a different analyst to look at. But the job of a really true value portfolio manager is to be obsessive, worrying about everything that goes wrong all the time. I'll give you one recent example in our portfolio. Charter Communications. We bought Charter Communications, 18 months ago, something like that. Got cheap, had some financial leverage, but not threatening financial leverage. And we all knew that video was done, right? No, they don't make money on video anymore. They were pricing it to break even. But broadband data was a big growing business. And two things were key to that premise. One is that it's very expensive and difficult for a second competitor to come in and lay the infrastructure, like Verizon Fios would have been one of those competitors, laying a second alternative to the cable network. And Verizon Fios started a business, grew it to something like 18 million subscribers and then stopped because they were not making enough money to justify the investment. So it sort of proved that case. And then you had the wireless companies that were offering fixed wireless, meaning that you could set up a little receiver in your home and using a cell signal get internet service. And they were way underpricing the cable operators. But our studying proved not to be correct either, was that they were limited in how much capacity they could take, how much market share they could take before they started undermining the high margin cell phone service, which is really what they're in business for. So we bought it, and it started off good. It looked like their losses stabilized. The stock went up. They were good for maybe 1 quarter before they started to going down again. And it was clear that we misjudged how big fixed wireless could be. Verizon announced that they were going to restart their capital spending program. And so what do? Our analyst wants to look at it and say, I want to study this because I'm sure it doesn't make sense that Verizon's going to do this. And we said, they said they're going to do it. Why do you want to study it anymore? So that's the job of the portfolio manager, right? To say, we got it wrong, we should exit. So you do. And you should either exit when something goes against you, or you should say, we got it right and we should double up. But you shouldn't automatically do either one. To me, it's you start over again and do it over and do the analysis over again.
And shifting into sort of more market type discussion here, anything that surprised you, particularly to the upside or downside this year overall in the stock market? And how do you think about heading into next year? How do you think the market's set up for next year?
Well, I'll answer that from my portfolio's perspective because, it's been a particularly good year for financial services. And this is in the value world, right? We're not invested in the big tech names that have gone through the roof. So I'll report this in 2 ways. One is that these companies have done so well and have started reaching their fair values after being undervalued since the financial crisis ended 16 years ago. And they've been generally really good investments during that 16-year period. But now you have to pay a full price for many of them. Some of them are still okay, and we haven't exited all of them. But that's been a nice, pleasant surprise. Going into all the Trump trade war issues, the consumer has remained strong, has continued to spend, and has continued to have strong credit with no deterioration in credit metrics. And I think that surprised everybody. And the stocks have been good performers as a result. I mean, I would say I'm surprised by the relatively small impact that all the tariff stuff has had on companies. It's had more impact on stock prices. So companies that are exposed to tariff issues have remained cheap for the most part, even though, because we all keep fearing that eventually it's going to hurt their businesses or their margins, but it's clearly hurt their share prices.
In technology, you spoke on it at the beginning of our discussion here. The fact that there's a handful of technology stocks that are a significant percentage of the S&P 500. Is that in contrast also to the internet bubble, right, where that was a big part of the market? Is this the new market regime that we're heading into because technology trends are so strong, or at some point there potentially is a shakeout where people will reassess, the dominance of these companies?
Well, I mean, there's no good value investor that wouldn't answer the latter. We look at these multi-trillion-dollar valuations that companies have, and you think, what do you have to believe to get those to be a reasonable price? And the answer is you have to believe growth rates and valuation and earnings margins that have no precedent. So we're always skeptical about believing that. It doesn't mean it can't happen. It can, and it's gone on for a long time. We today the AI is we have the winners in the prior generation like Microsoft and Google and Meta that have money, and so they can pour tens or hundreds of billions of dollars into building out data centers to host their AI offerings. And then you have the startup companies that have raised tens or hundreds of billions of dollars and now are engaging in all these crazy transactions with each other that make you, as a pure value person looking in from the outside, saying, I don't know how they ever pay for any of this stuff. But if AI lives up to its expectations and has a major impact on labor productivity, if you can take out 10% of your workforce, you can pay for all of this stuff. And so it's not an unreasonable perspective. I think it's unreasonable to have it be a third or more of your portfolio, or in some cases in the growth stock world, all of your portfolio. It's why it's our offering to the world. Look, we can still find interesting, good stuff. We don't have to pay giant prices for it. We can pay the prices we've always paid and get you a double-digit return. And getting a double-digit return starting at multiple trillion-dollar valuation is not a trivial exercise.
And do you think, you talked about investment, information technology as an opportunity. Are there a lot of, when you're in the value world, are there a lot of always sort of derivative plays off of what might be a big trend going on that you can find someone down the line?
They're sure, but they're controversial, right? So down the line would be, let's take we don't even own this one, but let's take an Accenture or a company that historically has been the partner of companies when they've waded into new technology. That's not happening right now. So their multiple has compressed dramatically. If it turns out that their revenues start to accelerate because they're helping companies get into the AI world, they can take off. So there are those kinds of businesses out there. Anything that has gotten AI in its framework, you wouldn't put in the category of being cheap these days. It's the ones where people think the AI is going to be displacing the companies where you may have an opportunity, just riskier than the way that you asked the question.
And I touched on some of the tariffs, a macro issue. Anything else that's sort of, that you think it might be worth being a concern? Employment, the Federal Reserve stance, inflation, they're all sort of headline risks. In your world, when you look at investing, how much weight do you give to macro? Is it macro specific to a company in general, or is it something different, basically?
For us, we tend to invest through a cycle rather than predict the macro. I broadly characterize it as there are two kinds of investors. The ones who try to guess what's going to happen next, and you can see the words I'm choosing, and position their portfolio accordingly. A lot of top-down investors. There are a lot of people who are very skilled at that. And then there are those who react to the macro environment. So, for example, everybody's afraid of tariffs, so any company that might have to pay them gets killed. But you know that the managements have ingenuity and they can modify. They're not stuck in the present. So that's more what we do. We don't so much as worry about the macro as much as we do understanding if the business franchise is strong enough to handle a period of adversity so that they can modify their businesses to come out clean on the other side. The two different ways of thinking about the same thing. We more are focused on long-term competitive threats. So crypto being a good example. I don't look at crypto to see if I want to invest in it. I more look at the technology underlying crypto to say, is there a threat to the banking system because somebody's figured out a better way of doing this? And now that we have all these stable dollar coins that are being, popularized and that can take the currency risk out of the equation and actually facilitate cheaper transactions, you have to try and figure out if there's a threat to the incumbents. And so that's I don't have an answer to that. We're in the heavy duty thought process about that because the big banks have all invested tens of billions of dollars in blockchain technology to try and preserve their business franchise and become more efficient. And to some extent, they're ability to accept deposits in a way that are viewed as safe and secure gives them advantage in that regard. But we'll see.
And artificial intelligence, the applicability to the investment management industry, is that, we've heard from some people say, well, that helps me write my investment letters and things like that. How is that being applied today, do you think? And what's the potential there for being helpful for the industry?
Well, today it's mostly applied, and I would conclude us in that, in making your team more efficient. So it makes the research team more efficient, not only the marketing teams and the writing teams. It also, you can use it to shorten the time that it takes to gather information. The analysis of that information we haven't turned over to AI at this point. Because what AI is very good at is observing the present. Making inference about the future is way more difficult because mostly the market is behavioral rather than, I can see that this business is growing faster than you think it's growing because I have all this data to prove it. That's kind of a momentum strategy, and it's very helpful for momentum type investors. I think less helpful for someone who's trying to find the thing that AI wouldn't like. But doesn't mean we're not experimenting. So I would say we're far away from turning over the thought process to AI.
And new product development for a firm like yours, is that an ongoing opportunity set that you're always sort of thinking through new products we can get into, or sort of a core 27 strategies, and that's what it'll be for a while?
I mean, for us, we pretty much have our strategies are what are all value, and every way you could slice and dice it, from U.S. small, mid, and large. We have concentrated and not concentrated. We have global, we have regional, we have emerging markets. There's not a lot more ways you can do it. We've recently incubated and now have a 3-year record on a credit strategy, which is think of as value investing in credit when the pricing of credit doesn't make sense. And it tends to be on the more first lien kind of credit where you're not looking at a total loss in a distress situation. So it's very promising. It's not a highly liquid marketplace, but it's very promising. But I would say mostly we have the ability to search down value anywhere in the world. And we'll see what evolves in credit. I would say more our product development has not been on new investment strategies as more on new formats to go to market, like ETFs would be a good example of that.
And lastly here, for non-professional investors looking to pursue a value approach to their investing style, what are the initial sort of due diligence checklist things you think they need to look at for people who just don't do it on a professional level but they have that bias, they want to find inexpensive stocks?
I mean, the reality is the quantitative stuff works, right? You can buy low price to book stocks. You can screen on low price to book, and you have a universe that you could start with. And if you screened on low price to book and then eliminated the ones that have excessively leveraged balance sheets, it's a good starting point. The checklist that I would say beyond the screen is where the interesting part comes in, and it depends how much work you want to do. But you could dig into what's going wrong with the business and read what the company says they're going to do to fix it and say, does that make sense or not make sense? You can look and say, is the history of this company a 20% return on capital employed over the last 25 years or a 5% return on capital employed? And so if I could find a 25% that's selling at a low price where it sounds sensible what they're doing, it's a very good start to without having a giant team of research people, but it's not work free.
Rich, thank you for joining us today and for sharing your perspective and valuable insights. And to our listeners, thank you for tuning in to Compound Insights from CFA Society New York. I'm Gary Farber, and we look forward to bringing you more conversations with leading voices in finance. We'll see you again soon.